Principal investments, exploring investment strategies and their societal effects. Agenda. Introduction to principal investments. Types of principal investments. Strategies for principal investments. Evaluating principal investment opportunities. Impact of principal investments. Introduction to principal investments. Understanding principal investments. Principal investments are the initial capital put into an investment opportunity aiming to generate future returns. Role in financial markets. Principal investments play a crucial role in financial markets by providing liquidity and supporting economic growth. Return on investment. Understanding how returns on investments are calculated and their significance in evaluating investment opportunities is essential. Difference between principal and interest. Understanding principal. The principal refers to the original sum of money that is invested or borrowed. It serves as the base for calculating interest. Understanding interest. Interest is the cost incurred for borrowing or the earnings from investment over time. It is typically calculated as a percentage of the principal. Evaluating profitability. Distinguishing between principal and interest is crucial for assessing the profitability of investments and loans. Proper understanding aids in better financial decision making. Examples of principal investments. Stocks. Stocks represent ownership in a company and offer potential for high returns but come with higher risk. Bonds. Bonds are debt securities issued by governments or corporations, typically offering lower risk and stable returns. Real estate. Real estate investment involves purchasing property, providing potential rental income and appreciation over time. Mutual funds. Mutual funds pool money from multiple investors to purchase a diversified portfolio of stocks and bonds. Equity investments. Ownership through shares. Investing in equity grants ownership in a company through its shares, allowing investors to participate in its growth. Potential dividends. Equity investments provide the possibility of earning dividends, which represent a share of the company's profits. Risks of market fluctuations. Higher returns from equity investments come with increased risks due to market volatility and economic changes. Debt investments. Understanding debt investments. Debt investments involve lending money to entities in exchange for interest payments, providing a steady income stream. Risk and return comparison. Typically, debt investments offer lower risk compared to equities, but they also provide lower potential returns for investors. Real estate investments, rental income. Real estate investments can generate steady rental income, making them an attractive option for investors seeking cash flow. Capital appreciation. Investing in real estate can lead to capital appreciation over time, increasing the value of the property and investor equity. Tangible assets. Real estate is considered a tangible asset, offering a physical investment that can provide security and stability. Active management required. Investors must actively manage their properties to maintain them and maximize rental income, which requires time and effort. Strategies for principal investments. Risk assessment and management. Importance of risk assessment. Assessing risks is essential for safeguarding principal investments and ensuring financial stability. Analyzing potential risks. Investors should thoroughly analyze potential risks to identify possible threats to their investments. Strategies for risk mitigation. Implementing strategies to mitigate identified risks is vital for ensuring long-term success and growth. Diversification, investment spread. Diversification involves spreading investments across various asset classes to mitigate risk effectively. Risk reduction. By diversifying, investors can reduce the impact of poor performance from any single investment. Stable portfolio. A well diversified portfolio can provide more stability and balance, leading to potentially better long term returns. Long term versus short term investments. Long term investments. Long term investments are typically held for several years, focusing on gradual growth and stability over time. Short term investments. Short term investments are held for a shorter period, often focusing on quick returns and liquidity. Risk assessment. Investors must assess the different risks associated with long term and short term investments to align with their financial goals. Evaluating principal investment opportunities, market analysis, trends examination. Analyzing market trends helps identify potential growth areas and consumer behavior patterns, essential for investment success. Competition assessment. Examining competition provides insights into market positioning and strategies to differentiate from rivals. Economic indicators. Reviewing economic indicators like inflation and employment rates informs the viability of investment opportunities. Financial statement analysis, understanding financial health. Financial statement analysis allows investors to assess a company's overall financial health effectively. Key financial indicators. Key indicators such as revenue, profit margins, and cash flow are crucial for evaluating company performance. Investor decision making. Analyzing financial statements aids investors in making informed decisions regarding investments and asset management. Due diligence, investment investigation. Due diligence involves a comprehensive investigation of investment opportunities to ensure sound decision making. Verifying information. It's crucial to verify all relevant information during due diligence to avoid potential risks and pitfalls. Risk assessment. Assessing risks associated with an investment is a key part of the due diligence process, ensuring informed choices. Impact of principal investments, economic growth and development. Role of investments. Principal investments are crucial for funding businesses and infrastructure, propelling economic growth and development. Job creation. Investments lead to job creation, enhancing employment opportunities and contributing to the overall economy. Innovation support. Funding from investment fosters innovation, allowing businesses to develop new products and services that boost economic growth. Corporate expansion and innovation. Role of investments. Investments play a crucial role in enabling companies to expand their operations and reach new markets. Innovation and competitiveness. Innovation enhances a company's competitiveness, allowing it to stand out in a dynamic business environment. Dynamic business environment. The cycle of investment and innovation fosters a dynamic and evolving business landscape that adapts to market demands. Societal and environmental considerations. Investor awareness. Investors are now more aware of the societal and environmental impacts of their investment decisions, influencing their choices. Sustainable investments. This awareness encourages investors to pursue sustainable investments that promote positive change for communities and planet. Community benefits. Sustainable investments can lead to benefits for local communities, enhancing their social and environmental well-being. Conclusion. Essential understanding. Understanding principal investments and their types is crucial for effective financial decision making. Evaluating opportunities. Effective evaluation of investment opportunities leads to positive contributions to economic and social development. Impact on development. Investors can significantly influence both economic and social development through strategic investment choices. Thank you.